Hello and welcome to the Finance Quarter. I'm Andrew Robertson. Everybody has heard of sexually transmitted disease, and in this liberated world in which we live, sexually transmitted debt is becoming an increasing problem. And just as we should take precautions to avoid disease, we should be just as vigilant when it comes to sexually transmitted debt. Melissa Brown is an accountant and author of books like Fabulous but Broke, and she says the effects of sexually transmitted debt can be just as painful and long-lasting as any sexually transmitted disease. Melissa, in very simple terms, what is sexually transmitted debt?
So sexually transmitted debt is debt I've received as a result of being in a relationship. So I've caught it simply because I've been in a relationship with someone. It's not necessarily malicious debt. It could be because I've been financially careless, but it's from having a relationship with either a friend or a spouse or a partner.
So what are some examples, and how damaging can sexually transmitted debt be?
Yeah, it can be extraordinarily damaging. It can be as simple as I want to help my boyfriend out and it's Christmas and he doesn't have a great phone and he's got terrible credit. So I go and get a phone plan for him. So I put it all in my own name, and then 2 months later he's racked up a huge debt. He's left with the phone and I'm left with a phone contract, but also a debt that I have to pay and no recourse. There's no way that I can say, oh, but I don't have that phone because the account's in my name. So that's the simplest form. It could also be, I've had clients where they've been in business together and she has a gambling problem. She's paying all the bills of the business and he's presumed that all the bills are being paid, but she's been putting it in the pokies instead. And she's ended up going into bankruptcy, but he's been left with an extraordinary amount of debt as a result of the bills not being paid. And it wasn't enough for him to say, well, I didn't do it, and I thought she was paying the bills. He was in an extraordinarily bad financial position as a result of that.
So how can you protect yourself against sexually transmitted debt?
Yeah, great question. I think you need to ask the question, what if? So what if everything was to go wrong? And that seems really awful coming from that deficit position, but if in that phone plan example, for example, if they'd asked what if, then you might think I'll buy a second-hand phone and a prepaid instead, because that way I'll protect myself if the relationship ends. Or it's asking a professional advisor what if. So if I'm being asked to be a director of a company, part of a self-managed super fund, co-guarantors on loans, asking that advisor, what if things go wrong? What happens to me?
I guess though, the reality is when you're starting off in a relationship, you get caught up in the emotion and the optimism and even the physical side of the relationship, and it's all going to live happily ever after.
Talking about money.
But what I hear you say is you should take a step back and take a hard-headed approach to money, even if it's the person you love you're dealing with.
Money just needs to be something else we talk about. And I'm a really big fan of, before we mesh our lives, before we open a joint bank account, go and rent somewhere together, do anything that involves us, then we need to be looking at each other's finances and having that transparency.
I know we're a finance program, not a relationship program, but it sounds to me also like you're saying choose carefully. You don't just tie up with anybody,
Look,
or a better way to put it.
It is, but it's also, just you love who you love. So it's not saying just because you're going to show me that you've got a $40,000 credit card debt and you haven't lodged your tax returns for 10 years, I'm not going to be with you. It's saying, well, let's understand that from the outset, and then we can make great decisions together on what to do with that.
So no secrets and no surprises.
Absolutely. Yep, definitely.
Melissa Brown, thank you very much for your time.
Thanks for having me.
The falling Australian dollar is creating some very interesting conditions for the retail sector. With the dollar down around 40% from its high in 2011, you'd expect stores like Harvey Norman, which is built on imported electrical goods, to be struggling. But Harvey Norman's profits are surging, and founder Jerry Harvey says he's not bothered by the currency.
I lived with the dollar under 50 cents for years, okay? I think it got as low as 45, 6, 7 cents at one stage. And we were going quite well then. Somehow or other we adjust. So from my point of view, I'm pretty happy with the dollar at 70 cents, but I won't be unhappy if it drops to 60. I'll still get by.
What's helping Harvey Norman is that foreign manufacturers like Sony and Samsung are wearing the currency losses in Australia because other currencies like the US dollar are moving in their favour. The internet is also helping, and as retail strategist Kevin Moore explains, it's driving a move towards more global pricing.
It's actually about the world saying, I can jump onto a screen, a small screen on my phone, or I can jump onto a screen on a PC or on a Mac, and I can look at pricing around the world. The internet gave us pricing transparency. And what happened is shoppers around the world said, I can see things cheaper, I might buy them. Everything from the smallest item to the largest item. And what we've had in Australia is 4 to 5 years where naturally importers, manufacturers, retailers have got their pricing in line with the rest of the world. We're almost at the point where we could be entering a golden age in Australia, where we have quite strong job growth, we have salary increases, but we have falling prices.
Fellow retail analyst Peter Ryan isn't so sure though. For him it's a simple equation. If the dollar falls, retailers' costs eventually must go up and price rises must surely follow.
Electronics is a very interesting area, and a lot of the manufacturers don't feel confident enough to lift prices because they don't think it will actually help sales. They think it'll knock sales down. It's a discretionary purchase. So where they can, where they're big enough, they're absorbing the price impact as best they can. In furniture, it's an interesting one because most of the raw materials in furniture come from offshore, and most of those contracts are done in US dollars. So eventually that will have an impact. In the short term, there may be some suppliers who aren't confident enough to lift their prices, or there may be some retailers who are putting the pressure back onto the suppliers to say, you absorb it because we don't want to. That's not sustainable. I mean, Milton Friedman's ultimate statement of economics was, what is economically unsustainable will not be sustained. Sooner or later, the cracks will appear in that strategy.
In our last program, we spoke with financial planner Suzanne Haddan about the pros and cons of fixed versus variable rate home loans. And if you'd like to see that interview, you can find it by clicking on the Finance Quarter icon on the business page of the ABC News website. Another issue around home loans are all the bells and whistles you get offered with some loans that you actually may not need. Suzanne Haddan kindly agreed to appear on the program again. Suzanne, when you want to buy a house, there's a myriad of loans on offer. What do you actually need in a loan?
Well, what you need is quite individual, but consistently I see you need the flexibility to make extra payments, but if you haven't budgeted as well as possible, to be able to redraw those extra payments if need be.
Why do you say that?
Well, the aim when you take a loan is for most people to pay it off as quickly as possible. So you take a loan at the start that you can afford, but circumstances change and you may be able to put extra money in. You want to be able to do that so you own your home sooner.
What are some of the features that are out there that you actually don't need in a home loan?
Well, again, it's hard to say across the board people don't need them, but here are a couple I think need close investigation. For example, one of the common ones is an offset account. 100% offset, where you pop money in an account and you don't pay interest on whatever money you have in that account. Well, a 100% offset account is the same as a redraw and extra repayment facility. You put money in, you can take it out if you need it. So why pay an extra interest rate for it?
And it's very confusing because we hear a lot about what's known as the standard home loan and the standard variable home loan rate. But the standard loan has a lot of those features that you don't need.
It does have a lot of features you don't need, but a lot of those features are quantifiable for you to determine if you need them. For example, if they say, we'll give you a 15% discount on your insurance, you know what your insurance costs, say it's $4,000, multiply it by 15% and determine if that saving is greater than the extra interest you're paying on the loan. Some benefits aren't so easy to quantify. It'll say something like, oh, if you want to split your loan between fixed and variable, you can do so without a fee in the future. Well, you have to make a decision at the beginning of the loan. Do you want to pay an extra 0.5% to have that flexibility?
So what I hear you say is that what's known as the basic home loan with the basic interest rate, which is often a little less than the standard variable rate, is actually all most people need.
I think it's a wonderful starting point, and will satisfy most people. Not everybody, but most people.
And quite separate to the features that are offered in a home loan, you should do some hard bargaining with your lender, shouldn't you?
There is a view, and I think it's valid, that the new customer is always more attractive to the financial institution. And that's kind of true. But let me tell you, if you've got a decent loan with them, and you tap on the shoulder, say, if you can't do better than this interest rate, I'm going to have to look elsewhere. I think they'll have the conversation with you. What's the worst that can happen? They can say no.
Well, politicians talk about that all the time. When interest rates go up, they glibly say, well, just move your banking elsewhere. But it's not that easy, and it is a lot of effort. I mean, what are your thoughts on that?
I think that's an important point. Administratively, it's painful because it's not simply doing a whole new application form. And as an accountant and a financial planner, we know you don't like pulling out your tax return. We know you don't like entering all that data in a new application form. It's not even just that. Houses have to be valued. Accounts have to be moved. You've got direct debits to your account. Your medical funds debited there. So it is a pain, but you have to decide. Let's say the saving is $2,000 per annum. You have to decide if that is a good employment of your time and the inconvenience to make the change.
So just in summary, what I've heard you say is you want a low interest rate and you want the ability to make extra payments.
That's the main thing.
Suzanne Haddan, thank you very much for your time.
Thanks, Andrew.
If you'd like to see any part of the program again, you can find us on the ABC News website. Just go to the business page and click on the Finance Quarter icon. That's all for this edition and for this year on the Finance Quarter. Have a happy and safe Christmas and New Year, and we'll see you again next year on the Finance Quarter.